Thank you, Mr. Chairman. And again, Chair Yellen, welcome back. And we welcome the decision, the announced intentions of the Fed to begin the process of reducing the size of its oversized portfolio. But in terms of the plan and in terms of portfolio composition and balance sheet normalization, why does your plan contemplate rolling off Treasury securities at a faster pace than mortgage bonds?
So the differences are relatively slight. My expectation is, although one can't be certain of what the prepayments of principal will be on mortgage-backed securities, that ultimately our caps on reinvestment of mortgage-backed securities will not be binding, that they will only come into play in exceptional circumstances. So once we've phased in those caps, I don't expect them to be binding. The Treasury market is very deep and liquid. It's a huge market. Our intention in gradually phasing up these caps is to avoid disruption, and we're comfortable.
Thank you for that. And this kind of gets to the question of credit allocation. Let me move on quickly to the issue of and the Fed's use of interest on excess reserves as a monetary policy tool. The Fed is now paying banks 1.25% on their reserve balances. And if the Fed follows through with its normalization plans, the Fed will be paying banks a higher interest rate on the reserve sometime later this year. These interest payments, as I said in my opening statement, provide banks with a government subsidy to not lend out their reserves. Does the Fed have any evidence that banks are passing on these higher interest on excess reserves rates to their customers in the form of higher interest rates on customer deposits?
So my impression is that on larger deposits on CDs, that we're beginning to see some upward movement in the rates that are available to customers, but not on retail deposit accounts. My expectation is, although there will be a lag, that as the general level of short-term interest rates rise, that competition among banking organizations will begin to put some upward pressure on those rates, and
yet we looked at some of the what some of the big banks pay on customer deposits, 1 basis point for many of them. Multiple institutions paying only 1 basis points on customer deposits, and the Fed is paying 125 basis points. And so it doesn't appear as though any of this pass-through is happening to customer accounts, and that might compel the Fed to reconsider the merits of its IOER policy. Wouldn't it be better for growth if banks were encouraged to deploy more capital in the real economy instead of just parking it at the Fed in exchange for IOER?
So I don't see banks as parking it at the Fed and not lending. My discussions with bankers and the information that we regularly collect suggests that banks are looking to make loans. There was a period of very slow loan growth at the beginning of the year, but our surveys suggest was more a matter of demand than supply. So remember, our interest on reserves is at a very low level.
If I could just interject.
Rates on loans,
yes, ma'am.
Uniformly high.
I would just interject an editorial comment, and that is that the dilemma that the Fed now appears to face is that lowering interest on excess reserves, of course, would decrease the Fed funds rate, but normalization would also entail moving back to the conventional open market operations. Let me finally, in my limited time left, talk to you a little bit about the limits of monetary policy. Of course, we know we've been struggling overall with slow growth and low labor participation, even though unemployment has come down. And you talk a lot about substandard productivity. What many employers say to me is that they simply can't compete with the government for labor and that the government is paying people to not work. And as you know, we're in the middle of this big debate in Washington about Obamacare and whether or not we should reform Medicaid. Here's what Alan Greenspan, who calls you a first-rate economist, said, quote, "You can't get growth going so long as entitlement expansion is anywhere near where it's been recently. It's eating up the sources of investment and the sources of growth. And you can't have it both ways. You cannot fund all of the entitlements everybody wants and expect that you're going to get a GDP out of that of 3% or more at an annual rate. The arithmetic just doesn't work. Wouldn't you agree that the structure of our welfare programs, including Obamacare, contain disincentives for work?
A brief answer, please.
So, to my mind, the major factor here is an aging population that is putting downward pressure on labor force participation. There are other factors that affect labor force participation as well, but the slow growth that we have and anticipate reflects in part an aging population and slow productivity growth.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.